Good morning. So we have quite a diverse group here in terms of location. We have Manipur, Bangalore, of course, Delhi, Kolkata, Kanpur. So a lot of locations. And of course, there are many more students who have probably not joined in today because either they plan to do part one later, or they would probably watch the recorded videos later. Some of you are doing part one. Some of you have already done part two. So therefore, I know uh, that there are many more people in this batch, and generally, a few most people watch the recorded videos, and there are only very few people who join the live lectures. But it's always good to attend live lectures. There is a nice interaction that happens, and it is always cherishing to interact with professionals. And this is a very diverse group, right? In terms of qualifications also. Normally in the other courses that I undertake, there is like one set of people, like more of one set of people, and then just couple of people from other kind of backgrounds, but it's mostly from one set of one type of qualification that are there in the other courses. CMA is one course where people come from very different backgrounds, because as you all know, that the eligibility here is that you must have passed class 12th, and you can straight away enroll for this course, and you can do it along with your graduation, regardless of the stream that you come from. Whether you had science, commerce, or humanities in 11th, 12th, you can pursue CMA. So it's a very diverse group, and people bring in their own experiences and their own sort of knowledge to the table, which adds to the quality of interaction that we have in the class. Um, so just to quickly give you my introduction, my name is Siddhartha Choudhary, and I'm a corporate trainer and a consultant. And at VGLD, I undertake a couple of courses, including, of course, the CMA Part 2 and Part 1. And I have worked with one of the big fours and then with a Fortune 100 company in India before moving to their headquarters at New York. Worked there for a while, then came back, and I started my own venture, which is into training, education, and consulting. And I've been very close to VG sir, right from my CA days. So by qualification, I'm a chartered accountant and an American CPA, and also certified in IFRS from the Institute of Chartered Accountants in England and Wales. So this is one of the sort of assignments that I enjoy. Like I said, people from diverse backgrounds, different, even different work experience. We have right from students, right, who have just passed class 12th and are probably in the first year of graduation, to vice president level people, attending this course. Right. So it's a very, very diverse group in every way, locationally, qualification wise, work experience wise. And therefore, it provides a very good platform to network with each other. And, which is very important in today's day and age. Success to a large extent depends on how many people you know, and more importantly, who you know. Right. So attending live lectures is always great. And I'm happy that you guys have attended, despite a chilly winter morning. I mean, it's not very chilly today, but yeah, the winter is setting in. And so, thanks to all of you for taking that effort and waking up in the morning and attending a live class. I'm sure we are going to interact much more, and cherish this experience. Just a couple of notes, quick notes that I want to share with you. One, because of this ongoing pandemic, we are conducting these classes from our respective homes, right? Whichever so in this case, of course, part 2 was also taken by me, and part 1 I am taking. But in other courses, like, we have different faculty members, so we are all taking our classes from home. And but we sort of make sure that the quality of the video and audio are good. So in case you face any issues with the audio video quality, please let me know in the chat box, and we'll figure out. Although we have not faced much of an issue, and we have been doing these classes for quite some time now, and the classes are going on smoothly, so I don't foresee any challenges on that front. But just in case, once in a while in a 3 hour 4 hour class, there could be a drop in the internet for a few seconds. So just bear with me. And that happens, like I said, maybe once in a 3 hour class, or maybe at most twice in a 3 hour class, and that too just for 5 or 10 seconds, right? So apart from that, we have not faced any major challenges. And one more note is that I have a dog at home, and he's very attached to me. So while I take the classes, he sits right next to me in my study, right? So today he's not around, but and he does not disturb us, right? I've been taking these classes with him sitting right next to me, throughout all these months of the pandemic. So just a note here that when the bell rings, there's this instinct in dogs that they immediately bark, right? So that could happen just again once in a 3 hour class, once or twice. If you can just bear with that, that would be nice. Of course, if it disturbs you, then please let me know. Please do not hesitate. Let me know immediately, and I'll take care of it. But like I said, it generally does not happen. In case it disturbs you, please let me know. All right. So about the syllabus, there are 6 chapters here, right? These are called units, and they are pretty vast, and they cover a lot of topics, from different sort of it's not like unidimensional. It is not just accounting. There are a lot of other things that you will learn in this syllabus, and particularly in part 1, right? And we are going to, of course, go chapter by chapter, and I will present some PPT slides to you, and we will go through those PPT slides, and they're pretty detailed. And you guys will, you have textbooks with you. I'm sure you have all received the textbooks. If not, then please contact the admin team, and they will immediately courier the books to you. So what you will have to do is, after the class, I'll share a quick statistic with you that, and I do this in every batch, just to convey the importance of this, that whatever we learn, whether it is academics or anything else, there's a study on this, and by the study has been conducted by big consulting firms, that whatever we study, we tend to forget 20% in the first 24 hours, right? So we forget whatever you will learn today, you will forget 20% of it by tomorrow morning. We forget another 20% within a week, and we forget another 20% within a month, of what we have learned. So if you do not revise what we go through in the class, and let's say you start revision after 2 months or 3 months, trust me, you would have forgotten 60% of what you have learned, right? And this is a study which has been conducted by, like I said, by big consulting firms, and a survey has been done on like a vast majority of people, right? And so I believe that this survey gives there is some credibility to this survey, right? So what is important here is to revise immediately, right? The same day, what you have learned that day. So for example, for whatever we learned today, take out just maybe one hour. I'm not saying take out another 3 hours to revise what we have covered in these 3 hours. You will probably have to take out one and a half hours to again go through what we have covered in the class. and then that will remain with you for a long time to come. You will not forget that very easily, right? So Saturday's class, you have Saturday. Sunday's class, you have the entire week to go through it. But like I said, try to do it on Sunday itself, so that before the week starts and you get busy with work, you have done your revision. And like I said, if you don't do it, then there's a tendency to forget things. And then after 3 months, when you start revising, it'll feel like you are doing it like pretty much all over again, right from the start, right? So you'll not be able to capitalize on these classes. So revision is very, very important. And in the class, of course, I'm going to take you through those slides that I just mentioned. And we are also going to do questions, MCQs, along with the syllabus. And then once we are done with the syllabus, I will try and earmark one, maybe two classes, absolutely dedicated to solving essay type questions. 1 or 2 classes, whatever it takes, even if it takes more than 2 classes, 3 classes, we can do that. And this is what we have done in CMA Part 2 also recently. Once the course was over, people got time to revise, and then we solved essay type questions in 2 classes and covering as many topics as possible in those 2 classes. So I'm going to do the same thing for CMA Part 1. So while we do the classes, during the next 2.5 months, while we are doing these weekend classes, after every topic, I'm going to do MCQ questions with you. But let me also put a word of caution here that, you will have access to the software. The software has certain number of questions, right? It's not infinite. So there are certain, of course, there are lots of questions there, lots of questions, but at the end of the day, it's a finite number. It is not an infinite number. Now, what will happen is the questions that we solve, in class, you would obviously get to know the answers of those questions. So when you revise and you try to test your knowledge, those questions will become sort of, useless, because you will be answering those questions from your memory, more than you answer those from your, real concept understanding, right? Because once you have seen the answer, it will remain in your subconscious mind for quite some time. So next time when you see the same question, you will obviously know the answer. Even if your concept is not clear, you will still give the right answer. And that is very dangerous, because it gives a notion that, you have understood the chapter and you have revised it, you remember things, when in fact, that is not the case, right? So it is very dangerous to go through questions without revising the chapter. So let me quickly share with you the approach that I generally recommend, and which has proved to be helpful to a lot of students. So I'm sure it is going to help you as well. I'm quickly sharing the screen here. Now, like I said, there are 6 chapters, unit 1, unit 2, unit 3, and so on till unit 6. And then each of these units have, topics inside them, which are called modules, right? So some units may have, 6-7 modules, some may have 8-9 modules. So the number of modules differ chapter by chapter. So you have these modules. Now we are going to cover all the modules of all the chapters, right? What you're going to do is, like I said, within the first 24 hours, you're going to revise these modules on your own, right? Along with class. As we keep doing in the class, you will keep revising. And that's it. Right now, you just have to do that. I mean, this is the bare minimum you have to do. Of course, you can do more, but this is the bare minimum that you have to do. Now, once we are done with the syllabus, right, then your actual revision starts. So when you start revising this, I'm not calling as revision, right? The first time when you are doing it along with the classes, I'm not calling it a revision. That's your first, obviously, that's your first time you're reading the book. So first revision, you will go through these modules and now you will go one by one, right? So let's say you will pick M1, module 1 of chapter 1 and go through it absolutely thoroughly, first word to last word of the module, right? You will not skip anything. So you'll go through each and every line, each and every word, first page to last page of that module, no matter how much time it takes. Okay, if it takes you half an hour to do that, great. If it takes you 5 hours to do that, then be it. You have to spend those 5 hours, right? So don't look at the watch when you're doing the revision for the first time. The idea is not to speed up when you're doing it for the first time. The idea is to get it right, to understand the concept so well, and where there is memorization required, right? So there is little bit of memorization required, not much. It's more of an understanding and concept based exam. But wherever there is little bit of memorization required, that you have memorized it as well. And your revision should be to an extent that after spending that 2 hours, 3 hours, 5 hours, whatever it takes to cover the first module, once you have done that, you should be able to recap the points, close the book and just try to think, try to visualize in your mind, what was there on page 1, what was there on page 2, okay, how many points were there, try to recap those points, right? So if you have, like, if you break down module 1 like this, that there were 3 topics in it. This was the first topic. It had 3 main points. The second topic had 4 main, points. And the third topic had, again, 3 main points. You should be able to recap these 3, 4, and 3s, total 10 points, without looking at the book. And now let's say when you're revising and you're not able to recap all the points, right? So let's say out of these 4 points, you remember the first 2 and you just can't remember what were the other 2 points. Okay, I'm just giving an example over here. Now, the tendency of students is to immediately open the book and see which 2 points, I'm not able to recap. Don't do that. I know it is very tempting, but don't do that. Put pressure on your mind. Try to think, I just read it. I just finished the chapter. I spent 5 hours in completing it. And it is not even 5 minutes or 10 minutes that I have completed it. Why can't I remember? Okay, so try to put some pressure on your mind. Try to, think what were the other 2 points. And if after trying hard, if you still can't remember, then of course you will have to open the book and see which 2 points you missed out, right? But do that after you have sort of exhausted your own, you have tried hard and exhausted, put in all your efforts, and then if you still can't remember, then go and look at the book. And by doing this, trust me, it is going to help you, in memorizing the thing much faster, and it is going to stay for a long period of time, right? You are not going to forget these 2 points, trust me, even till your exam. So try to do that. And then once you have reached that level where you can, you remember these 10 points. And when I say remember, I don't mean rote learning, because it is, like I said, more of a concept-based exam, right? An application of your knowledge rather than memorization. So you don't have to do a rote learning. Only in some specific areas you have to remember like exactly the points. But other than that, it's more of a concept-based. So as long as you remember the key points, that should be good enough, right? So once you have done that, then do the MCQs, right? So then do the MCQs. And in the first attempt, this is your very first attempt of MCQs on your own. In this round, you should get anywhere between 50 to 55%. That means if you have solved 100 questions of M1, I'm just giving a random example, you would get about 50 to 55. So do not panic, right? Because you must be thinking in your mind that I have done it so well. I spent 5 hours in doing this module. I even recapped all the points. and still I'm getting only 50, 55. That's normal. That happens with everyone. Nothing to panic. Okay. So, but what is important is immediately go back to the book. Once you have, done these 100 questions and you got your score, go back to the book and read it one more time. And this time it is not going to take you 5 hours. It's probably just going to take you 1 hour or 2 hours. But this going back to the book immediately after doing the questions is very important, because obviously now you are going to focus more on the areas where you got the answers wrong, right? And so do that and then move on to the next module. Okay, move on to the next module, repeat the whole process. Next module, repeat the whole process. Next module, repeat the whole process, right? So this way you have to complete the entire syllabus, all the way up to unit 6, and you would have done one round of MCQs. This is something I'm calling as revision 1. Okay, then if you plan to take part 2 as well, then go to part 2 and complete this exercise for part 2. Okay, and then come back to part 1 again. When you come back to part 1, this is your second revision. In the second revision, again go through the modules, but this time it is going to take you very, very short time, maybe just half an hour per module. Okay, and then do the MCQs again. And in this second round, you would see that you are crossing 80, 85, maybe 90 in the MCQs. But in this round, also do the essay type questions. Okay, do the essay type questions and complete your entire second revision like this, with all the MCQs of all the modules and all the essays of all the modules. Wherever there are, all modules may not have essays, right? Some of them may have, some of them may not, but wherever there are essays, you have done that. So this is something I'm calling as second revision. And then your final round of revision, revision 3. This time you don't have to go through the entire module, just do the highlighted portions, the important portions. MCQs, you don't have to do all the MCQs in this round, just do the marked ones. So there is a feature in the software that you can mark your MCQs. You can flag them, the ones that are important or the ones that that you got wrong in your first attempt, right? So you can mark them, and then when you go to the software next time, you can just choose the marked questions. It will not show you all the questions, it will only show you the ones that you marked. Okay, so in the third revision, just do the marked MCQs, but try and do all the essays, right? And this way finish again all the marked MCQs and all the essays of the entire syllabus. And this time when you do the marked questions, you should be crossing 90 in all of them. You should be crossing 90 in all your MCQs, the marked ones, and all your essay questions. The moment you have crossed 90 at home, you are absolutely ready for the exam, right? This is what I'm saying from experience of past students, that when you get 90 at home, you are ready for the exam. You can block your date and immediately sit for the exam. But what is important is to diligently go through these 3 rounds of revisions. This is the minimum I'm saying, and make sure that you get 90 in MCQs and 90 in your essay type questions, right? If you have done these 3 rounds of revisions and you have scored more than 90 in MCQs and essay type questions, there is no stopping you. Okay, then it's pretty much guaranteed, unless of course you get very, very unlucky on the day of the exam and you absolutely goof it up. That's a separate matter, and which is unlikely. After this diligent rounds of revisions and getting 90, it is unlikely that you will goof up in the exam. But it could happen in very rare circumstances. But yeah, you are if you have done these, you are pretty much good to go. All right, so Any questions so far? Anything that you want to discuss before I get started with the actual the content? Anything, guys? Anything at all? And I'm sure you know the windows. There are 3 windows in a year where you can appear for the exam. I think it is Jan, Feb, May, June, and then September, October, right? So you can block your date, and it's a computer-based exam. You have to go to a Prometric center to take the exam, right? So you have to block your date in advance, and you have to get yourself registered. Your registration must be done at least 1 month before your intended date of the exam. So make sure that once you're ready, once you think that you're ready to take the exam, uh, get yourself registered 1 month before, and then you can choose any window, any date, any time slot that are available. Of course, exams happen, I think, from Mondays to Saturdays. Sundays there are no exams. So Monday to Saturday, the entire month of Jan and Feb, any date you can choose and sit for the exam. Similarly, May, June, and then September, October. And from your registration date, you have 12 months. You can select any date within the next 12 months. It remains valid for 12 months. So that is one. And second is, once you have cleared one paper, you get 36 months to clear the second paper. Generally, it does not take, obviously it does not take 36 months. Generally people clear it in quick succession, right? But yes, the IMA gives you time of 3 years to clear the second one. Normally, like I said, people complete this entire course within 6 to 9 months, or at most in 12 months time. So right now we are in December 2021. Maximum by December 2022 you should become a CMA, right? Now, of course, one of the things is that you will get certified only when you have completed your graduation. Those who are pursuing graduation, you have to complete your graduation and then also have 2 years of work experience before you get certified, and you can write the letters CMA next to your name, right? So until then, you can write in your CV that you have cleared the 2 papers of CMA, but you cannot write CMA next to your name. You can do that only once you get certified, and for certification you have to complete your graduation and you have to have 2 years of work experience. And for that you have 7 years time, right? Once you clear the 2 papers, you have 7 years time, in which you have to complete your graduation and have 2 years of work experience, which is again sufficient time. Most of you are already graduates. Those who are not will become graduates in the next couple of years at most. So 7 years is a big time. And of course, you have to have 2 years of work experience as well. And then you can apply for your certification, for your certificate. And then, then you can write the letter CMA next to your name. Any questions, guys? Anything? Is the audio okay? The audio and the video, can you hear me properly? Okay. All right. So if there are no questions, then, let's get started. Okay. So Unit 1, 1A, Module 1. Okay. And this is optional because this is absolute basic accounting, that you have learned in class 11th. Okay. This is absolute basic stuff. And all of you are from the commerce background, right? At least in terms of your qualification, right? You all have done. Can I quickly ask you, did everyone have commerce in 11th, 12th? Can you quickly, write yes or no? Everybody had commerce in 11th, 12th, right? So this option, this background accounting cycle, this module is going to be absolutely easy for you. Let's get started. So to quickly answer your question, whether part 2 is tougher or part 1, well, both, both are equally, I would say equally tough or equally easy. I would not name one of them against the other. Both are equally, if you, like I said, if you do those 3 revisions, then actually it is very easy. And just let me tell you one more aspect, one more thing, that when you do your second revision, right, and then subsequently your third revision, there would be you would realize a lot of things that you did not realize while doing it for the, while doing your first revision, right? And that is normal. That is part of your evolution, right? It happens with a lot of students, and that basically that is an indicator that yes, you are progressing in the course. uh, you know the same paragraph, you're reading it, in your second revision, you had done it in the first revision, before that you had done it with me in class, right? But when you're doing the second revision, you will realize the actual significance of that paragraph, and you will think to yourself, how come I missed it in the first revision? How come I didn't realize this? Right? And this is very normal. This is very normal. It happens with everyone. And like I said, that is a pretty good indication that yes, you are progressing in the syllabus, that you are actually evolving in your thought process, right? So don't get panicked about it. It is very normal, and it happens with everyone. Okay. So accounting system overview. Primary purpose is to capture the economic activity of a business using the following steps, right? So what are the things that you do? Like, how do you capture a transaction in the books? You pass a journal entry, right? So you journalize the transaction. That is your first step. Then you post the transactions to the ledger, right? Which is called ledger posting, right? Post to ledger. Then you prepare the trial balance, which is called the unadjusted trial balance at this stage. And then you pass the adjusting entries, right? You pass the adjusting entries at the period end. If you're preparing monthly, then at the month end. If you're doing it for a quarter, then quarter end. And if you're preparing annual financials, then at the year end, right? So you pass adjusting entries. After the adjusting entries, you again prepare the trial, which is called the adjusted trial balance. And then from the adjusted trial balance, you prepare the financial statements. And the full set of financials consists of 5 statements, right? It consists of 5 statements. Number 1, the statement of financial position, which is the balance sheet. Number 2, the statement of income or the income statement. Number 3, let's say it is the statement of comprehensive income. Number 4 is statement of cash flows. And number 5 is statement of changes in owner's equity. Statement of changes in equity, right? Plus the notes, which are always an integral part of the financial statements, right? So the reason why these are called financial statements is because these are a set of statements. These are 5 statements, that is why they are called financial statements, right? So these are not accounts. These are not accounts. These are financial statements. And a full set consists of 5. The balance sheet, the income statement, the statement of comprehensive income, the statement of cash flows, and the statement of changes in owner's equity. So if you notice here, there is a word statement in each of them. Statement of financial position, statement of financial position, statement of income, statement of comprehensive income, statement of cash flows, and statement of changes in owner's equity, right? So that is the reason they are called statements, right? And obviously there are 5, so there is a plural over here. It is not financial statement, it is financial statements, right? There is a plural. So you prepare the financial statements from the adjusted trial balance, and then you prepare the closing entries, because you have to carry forward the balances from this year, the assets, liabilities, and equity from this year to next year. So this year's closing becomes next year's opening. And how does it happen? Through the closing entries, right? So you pass the closing entries. And finally, you prepare the post-closing trial balance to end the year. Okay. And one more, a quick note here, that we are, when we are talking about accounting here or financial statements, we are basically talking in the context of US GAAP. Okay, the US generally accepted accounting principles. So the terminology that we are going to use here is of US GAAP, right? Because this is a US based exam. So the references are to US GAAP and to IFRS, right? The International Financial Reporting Standards, because those two are considered general purpose financial reporting in the US, right? Which means that you can file your financials with the SEC, right? If you are a listed company, you have to file your financials with the Securities and Exchange Commission. You can file your financials which are prepared under US GAAP, or you can file your financials which are prepared under IFRS, right? Without providing any reconciliation. You can just simply prepare financials under IFRS and submit it with the SEC, right? So these are the two general purpose financial statements accepted in the US. Well, you can also submit financials which are prepared under any other GAAP other than US GAAP or IFRS. You can, but in those cases, you have to provide a reconciliation between that GAAP and the US GAAP. For example, if an Indian company is registered with the SEC, it is listed in the, let's say in the New York Stock Exchange, and it is registered with the SEC, the Securities and Exchange Commission, then it will file its financials either in US GAAP or IFRS, but it can also file its financials under Indian GAAP. But in that case, it has to provide certain reconciliations between, between numbers coming from Indian GAAP to the numbers as per US GAAP. For example, net income as per Indian GAAP to net income as per US GAAP. Okay, so you have to provide a reconciliation. But if you are presenting it or submitting those financials under US GAAP or IFRS, you don't have to give any reconciliation. That means they are fully accepted. Okay, what are adjusting entries and closing entries? We'll just talk about it. Adjusting entries typically cover your accruals, your unearned income, your prepaid expenses, right? So it basically covers 4 or 5 items, which you generally do at the end of the year. You pass the depreciation entry at the end of the year or end of the month. Whenever you're closing the books, at the time of closing the books, you pass the adjusting entries, right? So like I said, if you're doing monthly, then at the month end. If you're preparing quarterly, then at the quarter end. If you're doing straight away at the year end, then at the year end. So you pass adjusting entries at the period end, whether it is month, quarter, or year, right? And typically it covers 4 or 5 types of items. And we'll talk about that in just a moment. And closing entries, like I said, is to carry forward your balances, your asset balances, liability balances. This year's closing becomes next year's opening. And so you'll have to pass an entry to do that, right? Remember, nothing in accounting goes straight into the financial statements. There is a path that you have to follow, and this is exactly the path which is listed in this page from point number 1 to point number 8. You cannot, if there is a transaction that the entity has entered into, that transaction cannot straight go to the balance sheet or to the statement of income statement or any of the financial statements. It has to follow a path. You have to first prepare a journal entry, pass a journal entry, then you will do ledger posting. Then from the ledger, you will prepare the trial balance, and from the trial balance, you will prepare the financial statements, which consist of these 5 items, right? So it has to follow this path. You cannot skip any of this and go straight to the financial statements, right? So there is an entry. Everything will happen through an entry, right? And so even to carry forward your closing balances of this year, to make them the opening balances of next year, you'll have to pass entries. That is something you may not have categorically done in your 11th, 12th, but that those entries are also passed. Okay. All right, so let's move to the next slide. The accounting equation, again, something that you all are familiar with. Assets is equal to liabilities plus owner's equity, right? Also called stockholders' equity. Each transaction impacts the equation, proves the total economic resources equal the claims, right? So these are the resources, these are the resources, and these are the claims, right? So owner's equity is also called internal liability, and liability is external liability. Just liability is external liability, right? And owner's equity is sometimes called internal liability, right? So basically they are claims. So you have resources on one side and you have claims on the other side, and these two must always equal, right? Must always equal. Prepare proper journal entries, maintain equilibrium in the equation. Owners or stockholders equity can be split. Contributed capital represents investment made by owners, right? Investment made by owners is capital. And retained earnings represent wealth created for reinvestment in the business or to pay back as a dividend, right? So stockholders equity section typically has three items which are called CAR. The common stock, there's something called APIC, additional paid in capital, right? So when, let's say, you issue shares at a premium, the premium portion goes to APIC, additional paid in capital, okay? And then you have retained earnings. Typically, stockholders equity will have common stock, APIC, retained earnings. And then, of course, it could also have preferred stock, right? In the overall equity, it will also have preferred stock in case the company has issued preferred stock, right? But typically it will have common stock, APIC, retained earnings, which is called the CAR. Okay. Now, next page. Here we have an illustration which says for each of the following transactions, indicate the impact on the financial statements and ensure the accounting equation balances, right? So this is absolutely basic stuff. You can go through on your own. Let's just discuss maybe just a couple of them, just so that I can get you started on this. But this is absolutely, like I said, class 11th level accounting equations. The corporation issued additional 10,000 shares of capital stock to Harris Corp in exchange for $15,000 cash, right? So what is happening is you got cash, so cash is getting increased by 15,000, and because you've issued shares, right, your capital, stockholders equity, is getting added by 15,000. As simple as that. February 1. On February 1 itself, you purchased a building from Sweeney Enterprises for 150,000. Cash payment of 25 was made at the time of the purchase, and a note payable was issued for the remaining balance, right? So on one hand, you have assets going up by 150,000, but you also have cash going down by 25,000 because you paid 25,000 in cash. So your net increase in your assets is 125,000, right? Plus 150 minus 25, so 125,000. And your liability has increased by 125,000 because there's a note payable, right? Note payable of 125,000. Is that clear to everyone? And just notice here that I'm not saying 1,25,000. I'm saying 125,000 because that is how it is said, in the US, right? So here, because this is an American exam, right? We are going to try and use the terminologies that they use so that you get used to it. Okay, let's try one more. February 1. The third February 1 transaction is paid 7,800 for fire insurance on building for next 3 years. Okay. Now this one here says net effect 0. Why does it say that? Anybody? Why does it say net effect 0? Anybody? Yes, can somebody please tell me? Guys, can you hear me? Okay, so Rani is saying both are part of assets. Both are part of assets. How? Can you elaborate a little more? Why is it saying net effect is zero? You paid 7,800 for fire insurance on building for next 3 years. Why is it saying net effect zero? Prepaid debit and building credit. Feroz is saying prepaid plus cash net zero. Okay, so Rani, you will have to check your journal entry, right? Please check your journal entry whether it is right or wrong. Why would you credit building? And Feroz, yes, you are right. It is prepaid and cash because it is for the next 3 years. So we are debiting the prepaid and we are crediting the cash. So asset on one hand, an asset is going up, the prepaid is going up, which is an asset. And on the other hand, cash is going down. Yes, Rani, it's prepaid. So on one hand, prepaid is going up, which is an asset. And on the other hand, cash is going down, which is another asset. So one asset going up, another asset going down, net effect zero. But my question is, what about the month of February? In the month of February, will we not take some portion of it to insurance expense in the income statement? Are we not going to take 1 month's amount, the proportionate amount for 1 month, take it out of prepaid and take it to the income statement? That means debit insurance expense, credit prepaid. Are we not going to do that? Are you getting my question? My question is that on February 1, you did debit prepaid, right? Prepaid insurance, credit cash. Are you not going to take 1 month's debit insurance expense, credit prepaid? Yes or no? Yes or no? Yes. So then why is it saying net effect zero? P&L profit or loss will be impacting balance sheet. So in the equation, will it impact the capital? Is it going to impact the stockholders' equity? Come on, guys, this is very basic. Please quickly answer. If it goes to the income statement, then is it not going to impact stockholders' equity? So you said asset going up, another asset going down, net effect zero, right? Because this is an asset, prepaid insurance, it's going up. Cash is an asset, it is going down, net effect zero. I'm asking you about this second entry where your insurance expense is going up. So this is, if I say asset equal to liabilities plus equity, asset going up, asset going down, net effect 0, and nothing happens on the right hand side of the equation. But what about this? When you take some part of it in insurance and you take it out of prepaid, when you take it out of prepaid, asset goes down and expense will basically reduce your equity. Yes or no? Come on, guys. Yes or no? When you pass the second entry, debit, insurance, expense, credit, prepaid, your asset is going to go down because prepaid is decreasing. You're crediting prepaid means prepaid is decreasing. And then you're debiting expense. That means your equity is decreasing. Yes or no? Yes. So my question is then why is the answer saying net effect 0? Why is it not showing this? Yes, guys, anybody? Why is the answer saying net effect 0? Why is it not showing that asset is going down and equity is also going down? Any guesses? No? Well, the answer to that is because this is an adjusting entry. This will be passed at the quarter end or year end. And if you are preparing monthly, then at the month end. But this is an adjusting entry. We will pass this entry after we have prepared the unadjusted trial balance. Remember the first slide? First, we'll pass the normal entries. From these normal entries, right? So this is a normal entry. Okay, I'm just calling it a normal entry here. Normal regular entry. From this, we will do ledger posting. From this, we will prepare the unadjusted trial balance. Then we will pass the adjusting journal entries, and then we will prepare the adjusted trial balance. So right now in this question, they are testing you only up to this stage. They are not talking about the adjusting entries yet. Okay, and that is why they are not even considering this at this stage. Therefore, the answer is net effect 0. Is that clear to everyone? Okay, so why don't you give it a try? You know, these 11 points. Okay, first 3 we have already discussed. First 3 we have discussed. Why don't you give a try 4 to 11 and let me know tomorrow morning, you know, whether you could comfortably solve it, and please don't look at the answer. Please solve it first and then tally your answer with the answer given here on the right. Okay, but first try on your own. And if you're not able to solve this on your own, that means you need to brush up your 11, 12th accounts, you know, quickly. Otherwise, you're going to not understand a lot of things that we are going to cover here. And obviously, we are not going to cover 11, 12th accounting here. This is a professional course, and I expect you to know at least the basics of 11, 12th. I'm not asking you to know the basics, you know your BCom level stuff, because some of you are not BComs. So I totally understand that. But those of you who are BComs and MComs and MBA, you know, you must at least know what you have studied in your prior qualifications, right? But if you're not a BCom, then at least 11, 12th level, you know, you must quickly brush up and be, you know, get comfortable. And so we have a diverse group over here. So I'm not very sure which books you followed in school. You know, if you are from from southern India or from eastern India. Like we have people from Kolkata and we have people from Bangalore, etc. So I'm not very sure, but in the north, in Delhi, T.S. Grewal is a book that's pretty popular, right? I don't know if it is available in Bangalore, in Kolkata, etc. Manipur, I'm not sure. But of course, nowadays you get everything on Amazon and all. T.S. Grewal is a good book. Otherwise, follow the book that you have done in class 11, 12th, but just quickly do a recap of some of these basic stuff like journal entries, ledger posting, trial balance, preparation of the final accounts. There used to be a chapter on final accounts in class 11, right? So do those chapters and get, you know, get comfortable with them again. Now, this is something again you all know. Assets have a debit balance. So assets, we debit the asset when they increase, we credit the asset when they decrease, right? So debit, they have a natural debit balance. And if you look here, expenses have a debit balance. That means we debit all expenses and losses and we credit all gains and incomes, right? So these two are the ones that have debit balances, assets and expenses. Everything else has a credit balance. Liabilities have a natural credit balance. Equity has a natural credit balance. Within equity, you have common stock, you have retained earnings, and you also have APIC, like I said, which also has a credit balance, right? And then revenues and gains also have a credit balance. So everything else has a credit balance. If you just remember the A and the E, okay, the assets and expenses, they have a debit balance, right? Which means we debit them to increase them and we credit them to decrease them, right? And the opposite is with the case of liability, equity, revenues and gains. We credit them to increase. When the liability increases, we credit it. When the liability decreases, we debit it, right? Very basic stuff. Now, again, it says here, record the journal entry, right? So it is, once you have done your recap, try this question as well. And with, I will do the first three with you again. Corporation issued additional 10,000 shares of capital stock to Harris in exchange for 15,000. So debit cash, credit common stock, 15,000. And notice here that they don't write cash account debit to common stock. They don't write it like that. In the US, we don't write cash account debit to common stock. We write debit cash, credit common stock, right? 15,000, February 1. Then on February 1, we also purchased a building, right? So debit building, 150,000. We paid 25,000 cash. It's the same question. There you had to prepare the accounting equation. Here you have to pass the journal entries, right? And then there was no 125,000. Paid in February, we would debit the insurance expense and credit prepaid insurance. Okay, can you hear me now? Yeah. Yeah. So again, try this question at home, right? Journal entries, and let me know tomorrow morning whether you were able to solve it comfortably or not. If not, like I said, go through your 11th and 12th books quickly and try to do that within this week so that you don't miss out much from the next weekend's classes. Okay. So this is continuing here. February 11th, 16th, 18th, February 22nd, February 25th, February 28th, right? All right. Then comes the ledger posting. Now you will have to post these items to the ledger. Let's quickly see the first three entries that we did. So the first entry that we did was was debit cash, credit common stock, 15,000, right? So let's look at the cash account. Yes, we have the February one, 15,000. And then let's look at the common stock account. Here it is, 15,000 common stock, right? So debit cash, credit common stock. Second entry we did was debit building 150, credit cash 25, credit note payable 125, right? So let's go to the building account. Here it is, February 1, debit building by 150,000. Credit note payable 125,000 and credit cash by 25,000. Is that clear? The third entry that we did was debit prepaid by 7,800, credit cash by 7,800. Right? So once you have done the journal entry, the ledger posting is pretty simple. Then you prepare the unadjusted trial balance. And if you notice here, the unadjusted trial balance, obviously the trial balance has to tally and it has all the items. It has cash, AR, prepaid, payable, common stock, retained earnings, dividends, tutoring service revenue, wage expense, utility expense, right? So it has the revenues and expenses as well. It has the revenues, it has the expenses, it has the assets, liabilities, and common stock, APIC, retained earnings. In this question, APIC is not there, therefore it is not appearing. But if it were there, it would have appeared, right? So it has common stock, it has retained earnings, then it has the assets and the liabilities. Okay, now let's look at the adjusting entries required to ensure all revenues earned and expenses incurred are captured at period end. Adjustments follow the matching principle where expenses should be recorded to match their associated revenues, right? Matching principle. Expenses should be recorded to match their associated revenues. That means you have to recognize the revenue and the expense in the same period, right? That is the matching principle. You cannot be recognizing revenue in one period and expense in another, right? The associated revenue. You have incurred some expense to generate a revenue, right? So in the period you are recognizing the expense, you have to also recognize the revenue. That's a matching principle. Now, to do that, you have to pass, like I said, adjusting entries will have typically 4 or 5 items. The prepaid will have to be adjusted. The unearned revenue means you have received the money, but you have not rendered the service. You have not earned it yet, right? So you have received the money, but you have not rendered the service. Cash is received prior to providing the good or the service. Prepaid is where cash has been paid for a future benefit or usage, right? So prepaid is an asset. Prepaid rent, prepaid insurance, office supplies. It is initially recognized as an asset, but it is expensed as as used, as with the passage of time, it will start going to the income statement as an expense. So prepaid will keep reducing, and income statement the expense will start increasing. Unearned revenue is initially recognized as a liability and then recognized as revenue as earned. As we keep earning, we will take it to the revenue. The liability will keep reducing and the revenue will keep increasing, right? Assume that on November 1, year 1, Swift Corp prepaid 4 months of rent by paying 8,000. So if it prepaid, you will debit the prepaid, credit the cash. But on December 31, and this is 4 months rent, and it is paid on November 1, that means for the month of November and December, 2 months will fall in this year and 2 months will fall in the next year, right? Of course, assuming that this company is following the calendar year, right? And generally when the question is silent, you will assume a calendar year. Okay. Now 2 months fall in this year. That means we have to book the expense for 2 months, debit rent expense. Okay. So 4,000, credit prepaid 4,000, right? So initially you booked with 8,000 prepaid rent, and then you are debiting expense with 2 months of rent expense and crediting prepaid. So quickly, let me look at the questions. Accruals is unearned revenue. Well, unearned revenue is a liability. Unearned revenue is where you have received the money but not rendered the service. Accrual, if you're talking about from a revenue point of view, Firoz, then accrued income is actually an asset. Accrued income is the opposite of unearned if you're talking about revenue. Okay, so in revenue, there are two things we are talking about. One is unearned and the other is accrued. Unearned means cash received, good or service not provided, not rendered yet, service not rendered yet, or good not provided to the customer. Accrued is the opposite. Service rendered, you have already rendered the service to the customer, but cash not received yet. It's exactly the opposite, of unearned. Okay, does that? Vedanta is saying unearned revenue is prepaid, pre-received. Yes, you have received it in advance. It is prepaid revenue and pre-received. Yes, and Firoz, so unearned means advances. Yes, you have received it in advance. You've received the money in advance, but you have not rendered the service yet, and that is why it is a liability. And accrued is you have rendered the service, you have not received the money yet. It's an asset. Okay, so unearned is a liability. This is an asset when we are talking about it from the revenue point of view. Okay, from the revenue point of view, in the sense that this is unearned income, unearned revenue, and this is accrued income, right? We are not talking about from an expense point of view here. We're talking about from revenue point of view. But similarly, on the expense side, again, there will be two items. Prepaid, where you have paid the money but not received the service yet, and accrued expense or outstanding, right? Where you have received the service but not paid the money yet. Again, the opposite of each other. Prepaid is where you have paid, cash paid, service not received yet. And here it is service received, cash not paid. So you have to accrue for it. It's a liability, it's an outstanding. You have to pay for it, right? I hope it is clear to everyone. Prepaid is an asset. accrued or outstanding is a liability, right? So from revenue point of view, it gives rise to a liability or an asset depending on what has happened first, right? Have you received the cash, not rendered the service, or have you rendered the service, not received the cash? From an expense point of view, also there is an asset or a liability. Have you paid for it but not received the service yet, or have you received the service yet and not paid for it yet, right? So these are the 4 typical adjusting entries that happen every year. Apart from that, things like depreciation entries passed at the period end. You don't pass depreciation entry on a daily basis, right? You will pass depreciation entry for the month only once at the end of the month, or for the quarter only once at the end of the quarter, right? So it is also a typical adjusting entry. And then you will again do the ledger posting for these entries, right? So November 1, you had 8,000, and then December 31, you have 4,000. So now your prepaid has a balance of only 4,000. Similarly, rent has gone up by 4,000, rent expense. Is that clear, the ledger posting on this? And then once you have done these entries, so let's look at this one as well. Jan 1, year 1, they purchased $1,000 of supplies. Physical count of supplies available at the month end showed only 200 and supplies remain. Only 200 remain. So first is debit office supplies, credit cash with the entire 1,000 on Jan 1. But at the end of the month, which is Jan 31, you are only left with 200 in supplies. That means you will have to expense the 800. That means you have consumed the remaining $800 worth of supplies. So debit supply expense, credit office supplies 800, right? Right. So office supplies, first you debit it with 1,000, then you credit it with 800. Now the balance left is 200, and supply expense, you debit it with 800, right? That's your expense. Another one, they receive on May 1, year 1, Swift received $600 in prepayment from customer for 3 events that Swift will host. They have not yet hosted, right? So they have received it in advance. It's a prepayment. So if you look at the entry, May 1 entry, debit cash, credit unearned revenue, unearned, right? It's a liability because you have not performed the service yet. You have received the money. 200 per event. By the end of May, Swift has hosted 2 of the 3 events. That means now, once you have rendered the service, you have earned it, you can take it to your revenue, right? So debit the unearned and take it to service revenue for the 2 events, 200 into 2, 400 on May 31, right? So these are the adjusting entries. So like we have discussed already, accrued liabilities, accrued receivables. Accrued liability is obviously a liability. Accrued receivable is an asset. Okay. Examples here are Harris Investments has earned $1,500 in interest on investments in Dawson Enterprises at December 31. The interest payment will not be made until January 1. That means debit interest receivable, because you have not received the money, you will receive the money on January 1. You have earned 1,500, so you will credit the revenue, interest revenue by 1,500, but you will not debit cash, you will debit interest receivable. But on January 1, you will receive the cash, so debit cash and then credit the interest receivable. Now, the point is that on December 31, you have to prepare the financials. In the financials, you're going to show interest receivable, not cash, because you have not received the cash on December 31. Excuse me. Excuse me, sorry. Is that clear, everyone? Let's look at this last one. Assume employees earn wages of 35,000 per week based on a 5-day work week. December 31 is a Tuesday and payday is Friday. So just a quick note here, in the US, salaries are paid out fortnightly. That means every 15 days you get your salary, right? Not at the end of the month. Like in India, you get salary once a month. There you get salary, like it is split. The salary, of course, is same. Like if you are getting, let's say, $5,000 in a month, it will remain $5,000, but you will get it in two parts, 2,500 and 2,500. So you get salary every 15 days. Now, if December 31 is a Tuesday and the next payday falls on Friday, right? That means you will have to, and it's a 5-day work week, you will have to accrue. So December 31, debit wage expense, credit wage payable, 14,000, right? Because if it's a 5-day work week, right? You can do the calculation. 5-day work week, 35,000, that means it is 7,000 per day, right? 7,000 per day. And for 2 days, it comes to 14,000. On January 3, let's say January 3 is Friday. So January 3, when the payment will be made, you will credit cash, the entire 35,000 for that week, right? But Monday to Friday for the entire week, but you will debit wage payable for 14 because you had already accrued, you had already passed an entry for 14,000, right? So you will debit wage payable 14,000 and you will debit wage expense 21,000 for Wednesday, Thursday, and Friday. Basically, what it is saying is in this Monday, Tuesday, Wednesday, Thursday, Friday, Monday and Tuesday fall in this financial year, Wednesday, Thursday, Friday fall in the next financial year. But the payment is going to, you are going to get paid for these 2 days on Friday, right? Or rather, you will have to pay. So this is payable. You will have to pay. You are the employer here. You will pay for this Monday, Tuesday, which falls in 2021. You will pay it on January 3, right? This is Jan 1. This is January 2nd. This is January 3rd. This is December 30th. This is December 31. Right? You will pay it out on Friday. So for these 2 days, you will have to accrue for the expense. Debit wage expense, credit wage payable, 7,000 into 2, right? 14,000. And when you pay out, you will pay out for the entire week for 5 days. So when you pay out, you will pay out 35,000, but out of that 14,000 was already accrued. And this 7,000 into 3 falls in the next year. So it will be debit wage expense of 2022. This 21,000 will go to the 2022 income statement, the January 2022 income statement, and the 14,000 will go to the December 2021 income statement, right? This 14 will go to December 2021 income statement. This 21 will go to January 2022 income statement, right? Is that clear? Is this clear to everyone? Yes, this is very basic stuff, right? Okay. Estimates made in the accounting process. So there are a lot of estimates that are made. And like the example that I gave was, for example, depreciation, right? Depreciation is an estimate because the life of the fixed asset itself is an estimate, right? So you also pass entries relating to depreciation at the year end. So if you see here, December 31, debit depreciation expense, credit accumulated depreciation on building. They purchased the building for 50,000. It has a 25-year life, right? So on Jan 1, they purchased it on Jan 1. So on Jan 1, you have debit building, credit cash, if they paid cash. If they did not pay cash, then note payable, right, of 50,000. And it has a 25-year life. So on December 31, at the end of the year, you will pass the entry for depreciation with 2,000, 50,000 divided by 25, 2,000, assuming that they're following a straight line, right? Even if they're following a declining balance method, right? The first year could still be the same. The first year could be same in SLM as well as declining balance, right? So they call it declining balance, not written down value method. They call it declining balance method. Now, this is the adjusted trial balance after passing those entries of prepaid, of wages, interest receivable, wages payable, all those entries. Then this is the adjusted trial balance. And if you see here, now you would see that these new items have come into the trial balance of interest expense, depreciation expense, insurance expense, right? Earlier, in the earlier trial balance, if you remember, we only had tutoring service revenue, wage expense, and utility expense. Or let me quickly check. Yes, this was the trial balance. In this trial balance, we had only tutoring service revenue, wage expense, and utility expense. We did not have any other revenue or expense, right? These were the only three items. Now, if you see here in the adjusted trial balance, after passing all these adjusting journal entries, we have these new items coming in the trial balance: insurance expense, supply expense, depreciation, interest, right? These three were already there. Correct? And you also have unearned revenue. You have wages payable. You have interest payable. Right? So these entries are also new. These were not there in the previous trial balance. Right? So your adjusted trial balance looks different from your unadjusted trial balance. Now, closing entries. Adjusted trial balance can be used to prepare the financial statements. At the end of the reporting period, temporary accounts are closed. Temporary accounts include revenues, expenses, and dividends. They are closed. They will not be carried forward to the next year. What will be carried forward are the permanent accounts, the assets, liabilities, and equity, right? These are temporary accounts. And permanent accounts are assets, liabilities, and equity. So temporary will be closed. Temporary account and these will be maintained into the next reporting. Correct. Expense and accounts on the last day of the month, you will be right. So on the last day of the month, February 28th, you're going to debit the revenue. Revenues have a natural credit balance, right? So when you recognize revenue, you credited the revenue. Now you're debiting the revenue to close that account, and you're taking it to retained earnings, right? So you're closing the revenue account and taking it to retained earnings. Similarly, the expenses, you're going to debit retained earnings and credit all the expenses. Normally you debit the expenses, right? Now to close those accounts, you will credit the expenses and close the accounts, right? So you credit wage expense, you credit utility expense, insurance expense, supply expense, depreciation, interest. All the expenses are closed to the retained earnings, right? So revenues and expenses are closed to retained earnings. And obviously dividend also, you debit retained earnings, credit the dividend, and close the dividend account as well, right? When you pass the original entry for dividend, you did debit dividends, credit dividend payable, or credit cash. And now you are crediting the dividend account to close it, and and debiting the retained earnings. So basically all these items are closed to the retained earnings. And now if you see the trial balance, it would have reduced, or see, now it has become a very small trial balance because all the revenues, expenses, items, and dividend have gone. Now you don't have revenue, any expense and dividend. You only have assets, liabilities, and common stock and retained earnings. Assets, liabilities, common stock, and retained earnings. That's it. That is all is left. Yeah, that is all is left in your trial balance. Is that clear, guys? Now, do you understand the difference between unadjusted trial to adjusted trial to which is called the post-closing trial? Yes? All right. So let's look at the income statement now. Purpose. What's the purpose of the income statement? Purpose and use: to provide information about revenues, expenses, gains, and losses associated with company's operations during a specific period, right? Associated with company's operations during a specific period. Now, notice here that revenues, expenses are different from gains and losses, right? Revenues and expenses are different from gains and losses. So basically what I'm trying to say is that in US GAAP, revenues and expenses are shown as part of the operating section of the income statement. Gains and losses are shown in the non-operating section of the income statement. Right? So income statement, let me quickly tell you that the income statement, if this is the income statement, then it is first of all divided into two main parts, which is income from continuing operations and discontinued operations. And the total of those two gives you the net income, right? So what is your income from continuing operations? What is your discontinued operations? The total is net income. And within the income from continuing operations section, you have the operating part and the non-operating part, right? So you have operating, non-operating, total, income from continuing operations. In discontinued, you have three items: total, discontinued, and then the total of A plus B is your net income. A plus B is your net income. Okay, so this is how your income statement typically looks like. And revenues and expenses are part of the operating section of the income from continuing operations, and gains and losses are part of the non-operating section of the income from continuing operations. So they are also part of income from continuing operations, but they are the non-operating section. Is that clear, everybody? Is that clear, guys? Please, please say something, yes, no. If you have a doubt, please ask that. Keep interacting so that I know that you guys are listening. See, an online class is very different from a physical class, right? So here we have that additional level of interaction, right? So you could get simple theory based. Guys, can you hear me? Can you hear me now? Yes. Okay. So I was just saying that you can get a simple theory based MCQ question on the uses of the income statement. So for investors, it is profitability and value. For investors, it is profitability and value. For lenders, it is creditworthiness. For managers, it is useful for decision making. Okay, let's move to the next page. There is a single step income statement. There's a multiple step income statement, right? So US GAAP gives you both the options. You can prepare a single step, you can prepare a multiple step. Okay, so both options are available. In the single step, you show all the revenues at one place. You show revenues and gains, and you show all the expenses and losses at one place, right? So basically, if you have to visualize it like pictorial representation would be, you have all the revenues at one place. You have all the expenses at one place, right? So the gains are also here, the revenues are also here. The operating and the non-operating both are here. Similarly, in the expense, operating and non-operating both are here at the same place. That's called a single step. And then after doing this minus this, revenue minus expense, you get the pre-tax income. Okay, I mean, there are other layers in this, but basically you get the pre-tax income. Pre-tax income means earnings before tax or net income before tax. In fact, the word net income is generally used for after tax, right? So we will call it earnings before tax. Okay, and then from that you will deduct tax, less tax, income tax expense, you get net income. Okay, of course, here the assumption is that there is no discontinued operations. If there is discontinued operations also, then this whole thing will give you income from continuing operations. Instead of calling it net income, we will call it income from continuing operations, right? Income / loss from continuing operations. Then you will have discontinued, and then you will get net income. So if there is no discontinued operations, then income or loss from continuing operations also becomes the net income. Okay, this itself becomes, in that case, we will not even write income or loss from continuing operations. We will straight write net income. Okay, is that clear? Now in multiple step, we will have the operating, non-operating separately. We will have the operating part will be sales minus cost of goods sold, which is gross profit, minus operating expenses, the operating income. Then you have the non-operating section of the income statement where you will show the non-operating gains and losses. Then you will get the pre-tax income, and then income tax. Then you will get the income from continuing operations or net income. Is it clear, everyone? Clear about the single step and multiple step? Yes, great. Limitations, manipulation through assumptions and estimates, right? Like, we know that there are many areas in the financial statements where we use estimates, like allowance for uncollectibles, right? Which in India, we call it provision for doubtful debts. In the US, we call it allowance for uncollectibles. Similarly, provision for warranty liability, or let's say depreciation, the life of fixed assets, right? So these are all estimates. In inventory valuation, you will see that there are a lot of estimates, right? The net realizable value, NRV, cost or NRV, whichever is lower, or cost or market, whichever is lower. Now, the definition of NRV itself is estimated selling price minus the estimated cost to complete and dispose the item, right? So both are estimates. The selling price is also an estimate. The cost to complete the product is also an estimate, right? So there are lots of estimates involved in the preparation of financial statements. So that is, of course, one of the biggest limitations, that you could do manipulations. You could manipulate it by just, revising your estimate. Instead of having a 10% provision for doubtful debts, if you have 15% provision for doubtful debts, your net income number changes. And in a large corporation where the amounts are big, 1 or 2% up and down can also make a lot of difference, like in millions of dollars. Firoz is asking a question: in case of consolidation income, where to add or loss for subsidiary? Okay, so consolidation is a very tricky topic, and it is not, consolidation per se is not part of your syllabus here. It is part of other courses, other exams, like CPA has a complete chapter dedicated on consolidation. Okay, Firoz. So here you don't have to worry about consolidation, but just since you have asked the question, consolidation, where do you add or loss? Where to add or loss for subsidiary, you are saying? Basically, you mean where to add the income of the subsidiary or the loss of the subsidiary, right? Now, in that, we will have to see how much is the the income or loss from transactions with the parent, right? So intercompany transactions are eliminated in consolidation, right? So for example, if a particular item of inventory has been sold by the parent to the subsidiary at a gain, then we will have to eliminate the gain, right? So, like I said, consolidation is slightly tricky topic. Since you have asked the question, I'll give you a quick example. If this is the parent and this is the subsidiary, and let's say the parent has sold $100 inventory to the subsidiary for, let's say, 120, right? So now this inventory is not in the books of the parent. Now it is sitting in the balance sheet of the subsidiary, $120, right? So what we are going to do is, and this is still in stock. This is still in inventory. Okay, they don't call it stock, they call it inventory. And in fact, they call it inventory, right? So this is still in inventory of the subsidiary. So while doing consolidation, what we are going to do is we are going to bring this back to 100 as if this transaction never happened. So when we prepare the consolidated balance sheet, we are going to show inventory at 100, not 120. Similarly, we are going to also eliminate the gain of $20, right? The gain of $20 when we prepare the consolidated income statement, right? So consolidation is a very, very tricky topic, and particularly intercompany elimination within consolidation is a very tricky topic, right? But fortunately, it is not part of your syllabus here in detail. Okay. So you could manipulate the accounts through assumptions and estimates. For example, depreciation, the method of depreciation can change the amount, whether you are using straight line or declining balance method, or sum of the years digits method, or units of production method. The method itself can give you a very different number compared to other methods. Then useful life itself is an estimate. The salvage value at the end of its useful life is an estimate, right? Bad debts, like I said, evaluation of receivables, bad debt is an estimate. Warranties, provision for warranty liability is an estimate, right? So these are all estimates, and through this you can manipulate the account. That's one of the limitations of limitations of the income statement, that you can manipulate it. There is something called income smoothing. Income smoothing, that means instead of showing a huge profit in one year and a loss in another, or less profit in another, sometimes what the companies try to do is they try to smooth the earnings. That means a consistent level. Instead of showing a high amount in one year and a low amount in the other year, they try to smooth it out. That's why it's called smoothing. Now, benefit, better able to project future performance. So once income smoothing is done, you are able to better project the future performance, because at least you know that there is some level of consistency. But the detriment is it disguises the risks and alters the performance. The biggest detriment is it alters the actual performance, right? Because you have done a smoothing to it. Okay, so it alters the performance. That's a detriment. And the benefit is better able to project future performance. Then there is something called classification shifting. These are all limitations. Okay, these are all limitations. Number one, manipulation through assumptions and estimates. Number two, income smoothing. Number three, classification shifting. Classification shifting is, you show something as operating when it is actually non-operating, or vice versa. Okay, so again, you are trying to manipulate. Now, this is an example of a multiple step income statement. So let's quickly see how it looks like. Okay, you have net sales. So net sales, including goods, services, and rentals. So you have sale of goods, you have sale of services, you also have some rental, rental revenue coming in, less discounts and returns, minus the cost of sales of goods, services, and rentals, gives you the gross margin. Okay, so basically it is sales minus cost of goods sold, or sales minus cost of sales is the gross margin. And then you have all the operating expenses, right? You have the operating expenses, selling, general administrative, depreciation. After deducting the operating expenses, you get income or loss from operations. Okay, let me highlight these actually with a different color. Gross margin, income or loss from operations, right? The 240 and the -10. Then you have the non-operating, the other revenues and gains. So interest, if you notice, interest is a non-operating item. Gain on sale of fixed assets, any other non-operating revenues. Similarly, non-operating expenses, interest expense, loss on sale of fixed assets. After all this, you get income before income tax, the $250. Then you have the unusual items, loss on sale of available for sale securities, right? So these are unusual. These items are unusual or infrequent, unusual and infrequent. Okay. So unusual or infrequent, unusual and infrequent, both are covered here in the, in this part of the income statement after income before income tax. Okay, but actually this is a typo error. Income before income tax is this one. Income before income tax is this one. And then you have income tax expense. Then you have income tax expense. And finally you get net income or income from continuing operations. If there is discontinued operation in the question, then this line, this $50 will be called income from continuing operations. If there is no discontinued operations in the question, then this line, this $50 will be called net income. Okay, so here there is a typo error. This line is not income before taxes. Okay, the $250. This is basically income before unusual items. Okay, and these are unusual items, unusual or infrequent, unusual and infrequent, both are covered here. There is no concept of extraordinary in US GAAP anymore. Earlier, there used to be a concept of extraordinary items. Okay, extraordinary items. But now there is no such concept to align with IFRS, because IFRS did not have the concept of extraordinary. So US GAAP has also removed the concept of extraordinary now. There is nothing called extraordinary. Yes, unusual or infrequent, unusual and infrequent. Let me give you a quick example. Let's say tornadoes are very frequent in Florida. Okay, tornadoes are very frequent in Florida. A tornado happened during the year and it damaged your factory premises. There was a lot of damage. Now that loss is unusual. Tornadoes are unusual, but they are not infrequent in Florida. They are frequent in Florida, right? So this will be categorized as unusual or infrequent item. But let's say a tornado happened in New York, where tornadoes generally don't happen, right? But this year somehow a tornado came and it damaged your premises and there was a lot of loss. That loss will be called unusual and infrequent, because tornadoes are infrequent in New York, right? But earlier this used to be called an extraordinary item. The unusual and infrequent used to be called an extraordinary item, but this concept has been removed, right? So when this concept of extraordinary items was there, we used to show it in a separate part of the income statement altogether. Continuing operations, discontinued operations, extraordinary items, something like this. But now this extraordinary items are also part of income from continuing operations, but here it is neither operating nor non-operating. It is separately shown, but within the income from continuing operations section. This concept of extraordinary has been removed. Is that clear to everyone? Now, whether it is a tornado in Florida or it is in New York, both are going to be shown here in the income from continuing operations section, but separately from operating and non-operating. There is no separate section on extraordinary. Is that clear? Okay, Feroz is asking, is depreciation considered as an operating expense? Yes, of course. Okay. Guys, is it clear to everyone? Okay, great. Then let's proceed. Statement of changes in equity. To reconcile changes, to reconcile the changes in various equity accounts over a given period. So why do you have this statement of changes in equity? To reconcile the changes. That means what was the beginning, what is the ending, what was the movement during the year. what are the things that got added, what are the things that got deducted. You are showing the entire changes in equity, not just the beginning balance and the ending balance. You're also showing the movement. Okay, so users to understand the change in owner's claim to the net assets, right? So to understand the change, to understand the portion of equity representing investment of shareholders versus amounts earned by the entity. For example, retained earnings is something that has been earned by the entity, right? Because your net income goes and gets added to retained earnings. But common stock is investment of the shareholders, right? So it basically bifurcates or segregates investment of shareholders versus the amounts earned by the entity, right? So remember, I told you that equity will include common stock, APIC, retained earnings, right? So common stock is investment of shareholders. APIC is also paid in capital, is also investment of shareholders, versus retained earnings is the amount that has been earned by the entity, right? That has been earned by the entity. Okay, so the statement of changes in equity depicts these items. Commons, like I said, components are paid in capital, common and preferred. And APIC is the additional paid in capital. The par value goes to the common stock line, but the premium will go to the additional paid in capital line. Okay, so common stock, APIC, and then you also have retained earnings. And of course, in paid in capital, you're going to show the authorized issued outstanding. Retained earnings is net income minus the dividends. And also in the retained earnings, we will do certain adjustments like prior period adjustments, retrospective changes, right? So for example, if there is a change in accounting principle, okay, you can write here change in accounting principle. And what does that really mean is basically a change in a method of accounting. So let's say you were following FIFO earlier, okay? In India, we call it FIFO, LIFO. In the US, they call it FIFO, LIFO. So you were following FIFO, now you have switched to LIFO, for example. Okay, in fact, let me not give this example because this is actually an exception to the rule. Okay, let me give the opposite example. You were following LIFO, now you have moved to FIFO. Or you were following completed contract method in long-term construction contracts. Now you have switched to percentage of completion method. And by the way, both are allowed in US GAAP. LIFO is also allowed, FIFO is also allowed in US GAAP. LIFO is not allowed in IFRS. In US GAAP, LIFO is allowed. Okay, so LIFO, you are moving from one allowed method of accounting to another allowed method of accounting. Similarly, completed contract method is allowed in US GAAP. POC, percentage of completion method, is also allowed in US GAAP. So you are moving from one allowed method to another allowed method. That means this is not an error correction. It is not that you had committed an error earlier and now you are correcting that error. No, it is not an error correction. This was also allowed. So it was not an error, but you are still switching to another method, which is also allowed. That is called a change in, a change in accounting principle when you move from one method of accounting to another, and that you do retrospectively. That means you will have to basically, let's say, if your company has been in existence since 2000, since the year 2000, and now you are preparing the financials for 2021, right? Then right from the year 2000 to 2020, you will have to calculate that if you had followed POC right from the beginning, then what would have been your net income of these 20 years? Okay, right now you have a net income of these 20 years, let's say $1 million as per the completed contract method. But now you're saying that if I had followed POC right from the beginning, then what would have been my net income over these 20 years? Let's say that amount comes to $1.5 million. Where are you going to make this, give effect to this change of $500,000 or 0.5 million, $500,000 or 0.5 million? You are going to do that in retained earnings of beginning retained earnings of 2021 in this example. In my example, 2021, you are going to do this adjustment in the beginning balance of the retained earnings. You're going to add 0.5 million net of tax. You're not going to add 0.5 million straight away, but net of tax. Let's say the tax rate is 30%. That means $500,000 less tax of 30%, 150. You're going to add 350,000 to the beginning retained earnings of 2021, right? So there are certain adjustments that happen in the retained earnings. You of course add the net income of the year, you deduct the dividends, but you also do some prior period adjustments and retrospective changes in retained earnings. Is that clear to everyone? Is that clear? Okay, great. So if that is clear, that's great. Then we also have something called AOCI in the statement of owner's equity, statement of changes in owner's equity. AOCI, basically, there are certain items that do not go to the income statement, right? So you normally take your revenues and expenses to the income statement, right? If this is your income statement, you take your revenues and expenses to the income statement. And let's say you get your net income. This net income goes and gets added to your retained earnings in the balance sheet. But there are certain items, okay, in US GAAP, there are just basically, there is a, pension adjustments. There are certain pension adjustments that do not go to the income statement. Certain, not all pensions. Certain pension related items do not go to the income statement. Okay, so they are called pension adjustments. Then there is something called unrealized gain or loss on a certain type of security which is available for sale, debt securities. Okay, now don't worry too much about these items. I'm just giving you an idea of what is AOCI. Don't worry too much about these items at this moment. Okay. Pension adjustments, unrealized gain loss on available for sale debt securities. Then there is foreign currency translation adjustments. Then there is instrument specific credit risk. Instrument specific credit risk. And finally, there is effective portion of cash flow hedge. Okay, so these are some of the items. And in IFRS, there is one additional item which is called revaluation surplus. So these are some items that don't go to the income statement, but they go to a statement called, or basically an account called OCI, other comprehensive income. And just like net income goes to retained earnings in the balance sheet, the OCI items go to AOCI in the balance sheet. And both retained earnings and AOCI are part of the stockholders equity section in the balance sheet. Right, so stockholders equity section has common stock, APIC, retained earnings. It also has AOCI. And in case of consolidation, it also has minority interest, right? Or in fact, in the US, it is not called minority interest. In the US, it is called non-controlling interest, NCI. So there are many items that that are part of the stockholders equity section in the balance sheet. But of course, if we don't talk about consolidation right now, because that's a very, like I said, it's a completely different topic. If we don't talk about non-consolidation, then let's reduce non-controlling interest. Let's remove it from here. Then basically the four major items that are part of the stockholders equity section are common stock. Of course, if there are preference shares, then preferred stock, APIC, retained earnings, and AOCI. Okay. So these items that I mentioned here on the right, these items do not go to the income statement straight away. What happens is they go to the OCI, and from the OCI, they go and sit in the AOCI in the balance sheet. And over a period of time, they are taken to the income statement, right? They are taken to the income statement. Eventually, they will go to the income statement, right? But not directly. Right now, they'll go and sit in a statement called OCI. And then eventually from AOCI, they will come to the income statement, become part of net income, and then again go to the balance sheet and go and sit in retained earnings. Because net income goes and sits in retained earnings. So basically, it is just a matter of timing. Eventually, they will form part of income statement and they will go to retained earnings. But right now, they are sitting in AOCI. Right now, they are not ready to be taken to the income statement. Think of it like a parking lot. So think of AOCI like a parking lot. Let's say you have to enter this building. This example might sound silly, but just to explain the point, you have to enter this building and this is the parking lot. Okay, you are sitting in your car waiting for your turn, right? Whoever you have gone to meet, that person will call you when when that person is ready. Then they will call you, then you will go inside this building, right? So it is something like that. This is the income statement. This item is not yet ready to be taken to the income statement. So it is sitting in AOCI right now, the parking lot. When its turn comes, it will go to the income statement. Eventually, it will go to the income statement. And then from the income statement, as part of NI, it will go to retained earnings. Okay. That means, if you think of it, in the balance sheet, in the stockholders equity section, you have common stock, APIC, retained earnings, AOCI. To go from this item to retained earnings, it can't go straight away. It will go through the income statement. That means it will first be taken to income statement, become part of net income, and then go to retained earnings. So it will be routed through the income statement. Okay, it will be routed through the income statement. It can't straight away go to retained earnings. And then finally, you have something called treasury stock. Like when the company buys back its own shares from the market, that's called treasury stock. So that is also part of the stockholders equity section, but it's a minus. Treasury stock is a minus amount in the stockholders equity section. Okay. And this is how the statement of changes in equity typically looks like. If you see here, you have preferred stock, common stock, APIC preferred stock, APIC common stock, right? So maybe you issued both of them at a premium. Then you have retained earnings, you have accumulated OCI, the AOCI, you have treasury stock, and then total. And if you look here, you have Jan 1, year 5, the beginning balance, you have the movement, and finally the December 31, year 5, the ending balance. And you're showing what happened during the year, right? So in preferred stock, nothing happened during the year. Your beginning is also your ending. But in common stock, you had 990, you issued another 10,000. So now your closing is 1 million, right? So you're also showing the movement of what happened during the year. Look at retained earnings. You started the year with 11.26 million, 11.265 million. You added net income for the year. You also paid dividends. So now your ending retained earnings is this much, right? In AOCI, you have OCI of 12,000. That means those items of pension adjustments, unrealized gain loss on available for sale debt securities, instrument specific credit risk, effective portion of cash flow hedge, those items are totaling up to a negative 12,000. Some items could be items of gain. Revaluation surplus is an item of gain, whereas pension adjustment could be an item of expense, right? So the net amount is a negative here in this example. It could be positive also. It is negative in this example. So you started with 362, there is a negative 12. Now you're ending the year with a AOCI of 350. And also, by the way, items can enter into AOCI. Items can also exit AOCI and go to the income statement. Remember? So if this is the AOCI, certain items will get added to AOCI during the year, but certain items will also go to the income statement during the year. Right? So remember, you are not the only person waiting to get into this building. There are other cars also waiting. So you will enter when your turn comes. But if your turn has not come and somebody else's turn has come, they will enter into the building. So what I'm trying to say here is that, and let's say you were already inside the building and now your time has come to exit the building, then but somebody else's time has come to enter the building. So this guy is entering the building and you are exiting the building. Okay, you know what I mean, right? So okay, so let me slightly elaborate on that slightly more so that you get a clearer picture. What I'm trying to say here is that, let's say let's say pension adjustments. Okay, now pension adjustments, this is year 1 of your company, this is year 10 of your company. Okay, now in year 10 you started pensions, but with a retrospective effect of from year 1. So you're saying we'll pay pensions to our retiring employees, and we will start doing that right from year 1. Whoever were our employees right from year 1, we'll pay pensions to them. But you know, first 10 years in your company, pension was not applicable, right? Pension was not applicable, but now in year 10 it has become applicable. Now, so you calculate the liability for all these years, right? And let's say it comes to $10 million. Okay, so you will not take $10 million straight to the income statement. What you will do is you will take it to OCI, and from the OCI it will come to the income statement over a period of time. Let's say in the next 10 years, just giving an example here, that you will take it to the income statement of the 11th year, $1 million, $1 million to the income statement of the 12th year, $1 million to the income statement of the 13th year, $1 million to the income statement of the 14th year, and so on. You will take it to the income statements of these years over a period of time, right? So now let's say what happened is, in year, let's take any example, let's say in this particular year, you change the percentage. Okay, you change the percentage. You were contributing towards pension at a certain percentage of salary, right? but now you have started contributing more, again with a retrospective effect. Okay, so what will happen is, let's say that amount again comes to $5 million. Okay, because you were contributing, for example, 10% of salary of the people, of all your employees. Now you have increased it to 12% of salary of the employees. Okay, with a retrospective effect, right from year one. That means earlier you were doing the calculation based on 10% of their salary. Now you have to do the calculation based on 12% of their salary. So there is an additional liability of $5 million now. Again, you will put this $5 million in OCI and then take it to the income statement over a period of time. Right? So items keep entering into OCI and they keep exiting out of OCI. This $10 million entered into the OCI, but it is exiting the OCI. $1 million in year 11, $1 million in year 12, $1 million in year 13, $1 million in year 14. It is exiting OCI, entering into income statement. But in year 14, a $5 million entered into OCI as well, right? Because of this transaction. So what I'm trying to say is that it's a dynamic, items keep entering into the OCI. They also leave OCI and go to the income statement, and both can happen simultaneously. So there could be certain items that are entering AOCI, certain items that are leaving AOCI, and the net effect is 12,000 in this example. So now you are ending the year with 350,000. Okay, and if you total this up, this is just a mathematical total: 200,000 plus 990 plus 30 plus 2.475 million plus 11.265 million plus 362 minus 120 is the total stockholders' equity, beginning balance, and similarly the ending balance. Okay, is that clear? Firoz is saying, like in India's gratuity remeasurement. Well, yes, but Firoz, just one word of caution. While you're doing CMA, because this is a US-based course, I would sincerely urge everyone, not just Firoz, but everyone else, to not compare Indian GAAP versus US GAAP, or how we treat certain items in India versus how we are going to treat them in the US, because that is going to create confusion in the exam. Right? It's a multiple choice. One of the options would seem correct as per the Indian, GAAP, but may not be the right answer as per US GAAP. And in the pressure of the exam, right, there is, you have to complete the exam on time. The clock is ticking. There is so much left to do. There's pressure, and in that pressure, you might just give the wrong answer, because your somewhere in your subconscious mind, it will, your mind will tell you that yes, I have seen this somewhere. This is the right answer. But when you leave the exam hall and then you realize that that was the right answer as per Indian GAAP, not as per US GAAP. As per US GAAP, another option was the right answer, right? So please don't do comparisons while you are pursuing this course. You have, once you become a CMA, you have your entire life ahead of you to do comparisons. Right now, when you're preparing next 2 months, 3 months, 4 months, when you're preparing for CMA, don't do comparisons. I've seen that in the past that it does more harm to you than good to you. Okay, so comparisons can be done later. You have your entire life ahead of you. This is not the right time. Okay, elaborate on treasury stock. See, treasury stock is the shares that the company has bought, its own shares, which it had issued to the shareholders, and now they are trading in the stock exchange, right? It's a listed company. The shares are traded at the stock exchange. The company buys back its own shares from the stock exchange, some, not all of them, but let's say some. So if they had issued 10,000 shares and now they are buying back 500 shares, that's called treasury stock. Okay, when the company purchases its own shares, it's called treasury stock. Okay, and in this, there are, for how to account for treasury stock, there are two methods. One is called the cost method and the other is called the par value or the legal method. Okay, but don't worry, these are not part of your syllabus. the accounting treatment as such. It is negative because you have bought, the shares are not outstanding, you have purchased them back. So when you issue shares, you show it as a positive number, right? So if you, when you issue 10,000 shares of 10 each, for example, 10,000 shares of 10 each, what will you show in the balance sheet? You will show 100,000, a positive number. But when you buy back, let's say you have bought back 500 shares from the market at 12, you're going to reduce 6,000 and show the net amount at 94,000. This is of course one of the methods, right? But yes, this is how you're going to show. Okay. All right. State law. So limitations are state laws can cause differences because, in the US, different states have their own laws. So depending on your state law, there could be differences, obviously. Terminology variations can cause confusion, right? Terminology variations. In different gaps, different terminologies are used for the same item. For example, you could use the word accounts, the term accounts receivable. You could also use the word sundry debtors for the same item. You could also use due from customers. Right? So it basically means the same thing, but the terminology is different. Right? So that could create confusion. Use management discussion and analysis to fully understand. Right? So in isolation, these financial statements may give you some information, but it might make more sense or give you further insights when you look at the financial statements in conjunction with other information which is presented in the annual report. For example, director's report, management discussion and analysis, financials, financial summaries. So if you got to look at other information as well, so that you get a holistic picture. So that is again one of the limitations, that standalone it may not be as useful as the analysis will tell you. Like for example, if I just tell you that the current assets of a company is $20,000, you just know that, okay, fine, current assets is $20,000. You get that information, but then it does not tell you more than that. But when I give you certain ratios and I compare them with the industry standards or your competitors, then it will make more sense that, okay, this company's working capital or current ratio or quick ratio is this much versus the industry's this much. That means if this company's current ratio is let's say 2:1 and the industries is 1.5:1, that means their current ratio is better, their liquidity position is better than their competitors, right? So then you will start making analysis and it will make more sense. So in isolation, it may not be as useful, right? So that's one of the limitations. So state laws can cause differences, terminology can cause confusion, and MD&A, you have to use MD&A to fully understand the financials. Let's talk about the balance sheet. Provides assets, liabilities, and equity. This you all know. Shows types of assets and liabilities also, current, non-current, right? Which is also called marshalling of the balance sheet, right? Marshaled balance sheet means where you have segregated the current and the non-current, whether it is assets or liabilities. Can be used to evaluate liquidity and long-term solvency. So you can look at the liquidity position of the company by looking at the balance sheet, right? Like I said, how much current assets do they have? How much quick assets do they have? What is the cash and cash equivalents? So how liquid are they? And then long-term solvency, right? The debt equity ratio, for example, long-term solvency. And ratios is something that we have covered in detail in part 2. right? Those of you who have done part 2 know that we have covered ratios in quite detail. All right. Assets, current assets, investments, property, plant and equipment, intangibles, other. These are the main categories of classification. Current assets, cash and assets expected to convert to cash within 1 year, or you can just add here, it is within 1 year, or the operating cycle of the company, whichever is longer, or operating cycle of the company, whichever is longer, is a current asset, right? That means something that can be expected to convert to cash, within 1 year, or the operating cycle of the company, whichever is longer. So if the operating cycle of the company is 15 months, then 1 year is 12 months. So 12 or 15, whichever is longer, answer is 15. If the operating cycle of the company is 9 months and 1 year is 12 months, so 12 or 9, whichever is longer, answer is 12 months, right? So anything that can be converted to cash within this period is a current asset. And this is a very simplistic definition over here. Okay. Examples are cash, receivables, prepaid, inventory, short-term investments. Investments other than short-term investments, which are part of current assets, these are long-term investments, which are non-current and not directly used in operations. Okay, these are non-current. Short-term investments are part of current. Property, plant and equipment are tangible, long-lived assets and used in operations. Okay, so investments not directly used in operations, property, plant and equipment used in operations. Intangibles, again, used in operations, and other non-current assets, right? Very, very simple. Liabilities, again, current and non-current or long-term. Obligations to be satisfied with current assets and obligations to be satisfied beyond 1 year, 1 year or operating cycle of the company, whichever is longer. That's long-term. Equity is the difference between the assets and liabilities. So what is owned assets and what is owed liability. So difference between assets and liabilities, right? What is owned are assets, what is owed are liabilities. So difference between assets and liabilities is equity, right? Balance sheet presentation. Sorry. So if you see here, the balance sheet presentation, you have liabilities and stockholders' equity, and then you have right. So you have assets here, assets, and you have liabilities and stockholders' equity. 1025. This is basically, it's in continuation. It's a vertical format. It's not a horizontal T format, right? And by the way, horizontal looks like this in the US. The horizontal has assets on this side and liability and equity on this side. It is the opposite of how we do it in India. Okay, in US, they show assets on the left and the liabilities and equity on the right. Right, so in that sense also this is fine. Like this can be treated as a horizontal balance sheet, because here also you have assets on the left and liabilities and stockholders equity on the right. Right, so it can be treated like that as well. And vertical is like one below the other and not side by side. Right, so this is side by side, assets on one side, liability and equity on the other side, and vertical will have one below the other. Okay, so the point here is that You have assets, in that you have current. In the liabilities also, if you see, you have current. That means it starts with current assets and then goes to the non-current. Similarly, in the liabilities, it starts with current and then goes to the non-current, and the stockholders' equity is after that, right? So stockholders' equity, current liabilities, long-term liabilities, and then stockholders' equity, and current assets, and then investments, property, plant and equipment, intangibles. Okay, these are the classifications. This is called marshalling of the balance sheet. This is a marshaled balance sheet. And in stockholders' equity, if you notice, you have common stock, APIC, retained earnings. In this particular example, only 3 items: common stock, APIC, retained earnings, which is referred to as CAR. Limitations: does not represent the market value of the entity, because these are not, all these items are not as per the market value. Some of them are on historical cost. For example, property, plant and equipment are all on historical cost, right? Accounts receivable is on net realizable value. Inventory is on lower of cost or market, depending, actually it depends on which method you have followed, right? So it could be lower of cost or market, or lower of cost or NRV, right? So different items have been measured using different measurement basis. We call them measurement basis. Right, so different items in the balance sheet have been valued using different measurement basis. For example, bonds payable is on present value, PV, present value of future cash flows, right? PV FCF. Right, so different items have used different measurement basis, and therefore the balance sheet does not reflect the market value of your assets. It does not. This $200,000 is not the market value of the land. This is the cost at which you had purchased this land maybe 30 years ago, right? Maybe it's a 30-year-old company. This land was purchased 30 years ago for $200,000. Current market value may be $20 million, right? But the balance sheet is not reflecting that. It is still reflecting what at the price, the cost that you had purchased it for, right? So it does not represent the market value of the entity. Many assets and equity issuances measured at historical cost. Like I said, some assets require measurement which are subjective, make comparison difficult. Estimates may be used in preparation of the balance sheet. So these are some of the limitations. Estimates are used. Then there could be subjectivity involved, making comparison difficult. And then historical cost is used for certain items. Preparation of financials. So you have to prepare the income statement, which gives you the net income, then changes in stockholders' equity, because net income goes to retained earnings. Excuse me. Excuse me, sorry. Net income goes to retained earnings, which is part of the changes in stockholders' equity. And then retained earnings itself is a part of the balance sheet. Balance sheet gives you cash. It depicts the position of cash and cash equivalents, which is a component or an ingredient in making the cash flow statement, right? So financial statements, are somewhat, of course, they're interlinked. All right. Articulation of financial statements. So as we saw, income statement shows net income. Balance sheet has all your assets, total liabilities, and equity. Statement of retained earnings, you start with the beginning balance Jan 1 year 1, add the net income less dividends, you get the December 31 year 1. Notice here how the date is mentioned. It is month, date, and then year. 12/31 year 2 means December 31 year 2. Then you have statement of cash flows. So you take the cash from the balance sheet. And if you see here, that is your beginning cash of $30. This is your December 31 year 1 balance sheet. December 31 year 2 balance sheet has cash of 40, which is the ending cash in the cash flow statement, right? So cash flow statement has operating, investing, and financing activities. Operating, investing, financing. The total of those three is net increase, right? This is the total of those three items. 10, you had beginning 30, therefore your ending is 40. 10 plus 30 is 40, right? So 10 plus 30 is equal to 40. And how did you get to 10? Basically 11.5 plus 92 negative 92.8 and then negative 14.7. There's some typo here, looks like, but basically, you know, it is supposed to be an addition of these three items. Okay. Okay. And this, if you look at this net income, 95.5. So net income has gotten added. If you look at retained earnings beginning was 439.2. So it is 439.2 here. And then ending is 498, which is in the ending balance sheet, 498. Right. So it is basically showing the linkages. Statement of cash flow. Again, it is on cash basis versus accrual basis. So your income statement is prepared as per accrual basis, but cash flow statement is basically on cash basis. That means what basically we are saying is that, you know, whatever cash has been received during the year and whatever cash payments have happened during the year. And when I say cash, it means cash and cash equivalents, not just cash, but cash equivalents, which include your bank, right? It include your other certificate of deposits, which will mature within, you know, within 90 days, right? So those are all considered cash equivalents. So it is prepared on a cash basis. Cash flow statement provides information and sources on source. Sorry. Yeah. Provides information on sources and uses of cash and cash equivalents. Then, of course, it helps you in assessing liquidity and solvency because you get to see your cash and cash equivalents position, right? Which will help, which basically cash is a component of your current quick assets and current assets. So it helps you in determining liquidity and also the solvency part of it, because you must, what is solvency? That you should be able to pay your debts when they become due, right? So if you have to pay to accounts payable, if you have to pay to your sundry creditors, you should be able to, you must have enough cash and cash equivalents to pay them when they become due, right? So it helps you in assessing the solvency position of the entity. And it is used by all these parties, the investors, creditors, shareholders, vendors, regulators, tax authorities, and anybody, like there are more parties that use the financial statements, including the cash flow statement. Okay, but let me tell you, there is something called primary users, and then rest, everybody else is a secondary user of the financial statements. So primary users are only these four parties, and you can note it down if you want. Who are the primary users of financial statements? The existing investors, potential investors, lenders, and creditors. These are the four primary users of financial statements. Everybody else is a secondary user. Okay. So for example, your vendors, your regulators, tax authorities, even the Securities and Exchange Commission are all secondary users of the financial information. Primary users are, in this particular line, if I have to note, I'll say investors, creditors, shareholders. Okay, existing investors, potential investors, lenders, and creditors are the primary users of the financial statements. And then cash flow statement has these three items: operating, investing, and financing. And this has to be in this order. Remember, it cannot be operating, financing, investing. It has to be operating, investing, financing, OIF. So the easy way to remember is it is in reverse alphabetical order. In the alphabetical order, F comes first: A, B, C, D, E, F, G, H, I, J, K, L, M, N, O. Right? So it is in the reverse alphabetical order, right? FIO, but then you have to present it in the reverse alphabetical order. So O will be presented first, then I, then F. Okay, operating, investing, financing activities. And operating activities. Okay, let's first talk about investing and financing. Investing is purchase and sale of non-current assets. So land, building, equipments, machinery, tools, furniture, fixture, all the non-current assets, purchase and sale. Financing is the cash inflows and outflows from the non-current liabilities and equity owners of the company, right? Basically, if you look at it from this point of view, if you can divide the balance sheet into three parts. Who is financing your business? With whose money are you running this business? It is the shareholders' money, the investors, and the lenders, if you have taken any loan from banks or financial institutions, right? So non-current liability, creditors, and the owners, the equity, right? So who is financing your business? That's financing activities. Where have you invested this money? In investing activities, right? In land, building, etc. You have that is where you have invested this money. And operations is all your current assets minus current liability, the working capital, right? So if you look here in the working capital, it is the current operating assets, the current operating liabilities, right? So you can basically divide the balance sheet in this fashion. This is the financing activity. Anything to do with this section of the balance sheet is financing, right? You have issued shares, you have bought back your shares, you have issued bonds, you have repaid the bonds on maturity, you have taken a loan, you have repaid the loan, everything, all this, anything to do with this area of the balance sheet is financing activity. Anything to do with this area of the balance sheet is investing activity. You have purchased land, you have sold land, you have purchased building, you have sold building. Basically, the cash inflow and outflow pertaining to these transactions. When you purchased a building, cash went out, it's an outflow. When you sold a building, cash came in, it's an inflow, right? And anything to do with this part of the balance sheet, the current assets and the current liabilities, is the operating activities section, right? That's an easy way to remember. Okay. Non-cash investing and financing activities are basically items where neither cash is coming in nor cash is going out. You acquired a building and issued shares. right? So you acquired a building and issued shares, neither did cash come in, nor did cash go out. Okay. So if you look at the format here of the cash flow statement, okay, they've not shown the format here. This question is basically asking you to segregate these items into operating, investing, financing, and non-cash. So if you see the answer here, issued shares is a financing activity. Sold land is an investing activity. AR increased, current asset increased is an operating activity. Purchased a machine is an investing activity. Sold bonds, financing activity. Sold bonds means issued bonds. In the US, they don't use the word issue, they say sold. So sold shares or sold bonds. Well, here they have used the word issued shares in the first point, but generally they will, in the exam, they will say sold shares. The company sold 500,000 shares, which means they have issued the shares. Okay. Sold bonds means issued bonds, financing activity. AP decreased, current liabilities, operating activity. Short-term note payable again, but even though it's a short-term note payable. So remember one thing, both note payable, both long-term and short-term, are financing activities. Then treasury stock, purchased treasury stock, financing activity. Issued bonds in exchange for a machine. It's a non-cash item. And then declared a cash dividend. You have just declared, you have not paid it yet. So it is not included. Dividend will appear once it is paid. Okay. So, you can get these kind of simple questions. You can also get a question on how to preparing the cash flow statement, right? Which we'll also cover. We will also cover in essay type questions. Okay. Cash basis does not match accrual basis recognition of revenues and expenses. Obviously, cash basis is different from accrual basis. Obviously, the both won't match. In accrual basis, like we discussed today, the adjusting entries, right? You are accruing. You have not paid the wages. You will pay the wages on 3rd of January, but you have accrued for it, $14,000. In cash flow statement, we are not going to show that $14,000 anywhere because we have not paid it yet, right? Management decisions may not be fully reflected. Issuing debt reflected as a cash inflow does not represent future cost, right? Cash, when you issued bonds, for example, you got money, so it's a cash inflow. Buying equipment reflected as a cash outflow does not represent future benefit, right? So when you bought equipment, it was a cash outflow. Okay, so may not represent future cost or future benefits. That is what they're trying to say. Net income. So income statement, inputs. Where do you get the inputs to prepare the cash flow statement? You get certain items from the income statement. You get certain items from the statement of equity, then from the balance sheets. Comparative, why? Because you need to know the opening also. You need to know the opening cash and cash equivalents. You need to know the closing cash and cash equivalents, right? So you have to take numbers from both the opening balance sheet and the closing balance sheet. That's why they're calling it comparative balance sheet. And then footnotes. From the notes to the financials also, you get certain information on non-cash items. So what do you get from the income statement? You get net income, you get non-cash items, the gains and losses. From statement of equity, you get dividends, other equity transactions like issue of shares, issue of bonds, etc. From the balance sheet, you get the changes in the balance sheet accounts, like we saw in this previous example, AR increased by this much, AP decreased by this much, or the cash and cash equivalents opening and ending balances. From the footnotes, you get the non-cash transactions, right? So you basically use the balance sheet, the income statement, the statement of equity, the footnotes. You use a lot of information to prepare the cash flow statement. So here they have given you the items. I know it's 11 o'clock already. Let's quickly finish this. Net income plus non-cash expenses. And see, this cash flow statement, you have done it in class 12th, right? Cash flow statement was a chapter in class 12th in CBSE, those of you who have done CBSE, right? So you already know this topic very well. Net income plus non-cash expenses plus losses minus gains, okay? Plus the losses minus the gains. Then decrease in current asset is a plus. Decrease in current asset is a plus. Increase in current asset is a minus, right? And the opposite is with current liabilities. In current liabilities, increase in current liability is a plus, and decrease in current liability is a minus. So remember one thing, for current assets, there is an inverse relationship. Right? That means current asset decrease is a plus, current asset increase is a minus, right? So for current liabilities, it's a direct relationship. That means current liability increase is a plus, current liability decrease is a minus. Okay. Okay. And of course, losses and expenses you will add, expense you will add, loss you will add, and gain you will deduct. Gain you will deduct. Simple way to remember operating activities. Investing and financing are very, very simple. Investing, any purchase or sale of property, plant, equipment, trading securities, classified as non-current. If it is current, then it will go to operating part. And if it is cash and cash equivalent, then it will be added to the opening and closing balances of cash and cash equivalent, right? So trading security could appear in like different places depending on the question. Available for sale securities, held to maturity securities. Basically, these are all investments that you have made in securities of other companies. You have purchased shares of other companies, you have purchased bonds of other companies, you have made investment in other companies, right? So these are your assets in the balance sheet. Property, plant and equipment, trading security, available for sale, held to maturity, acquisition of other entities. You have totally acquired another entity. You have purchased 100% shares of another entity. Okay, so all these are investing activities. Trading only if it is classified as non-current. Then financing is, of course, issue of shares, which is called stock, bonds, long-term note payable, payment of dividends, right? And we saw there in that example that even short-term note payable has been considered, right? And remember, payment of dividend is a financing activity. So please note this, what I'm about to write here. Please note this down. This could be important for you. Interest received is an operating activity under US GAAP. I'm talking about US GAAP here. Is an operating activity. Interest paid is an operating activity. Dividend received is an operating activity. Dividend paid is a financing activity in US GAAP. Okay. In IFRS gives you a choice. Interest received is operating or investing. Interest paid is operating or financing. Dividend received is operating or investing. Dividend paid is operating or financing. Right, so IFRS gives you a choice. US GAAP does not give you a choice. US GAAP treats these three items as operating, only dividend paid as financing. Okay, the question will be clear about whether it's a US GAAP based question or an IFRS based question. If the question is silent, then consider it as a US GAAP question. right? So as you can see, there are differences between US GAAP and IFRS. So here is a question, and if you look at the solution, like I said, first it will be operating, then investing, and then financing. So this question probably does not have any operating required. Okay, yeah, prepare the investing activities section and the financing activities section. That's why it is not showing any operating. It is just showing investing and financing, right? So sale of equipment, sale of building, purchase of securities, sale of securities. These are all investing activities, right? Of course, trading security, if it is considered as non-current. And then financing, issue of long-term debt, long-term note, sorry, then payment for retirement of bonds, payment of dividends are financing activities. And then net change, you add the operating, investing, financing, you get the net change, and then you add the beginning balance of cash and cash equivalents to that, you get the ending, like we saw in that in a slide earlier, right? So you add total all the operating, investing, and financing, you get the net change in cash, and then add the beginning, you will get the end of period balance. Okay, and non-cash items will be some non-cash items are shown as supplemental schedules to the cash flow statement. Here, supplemental disclosures of cash flow information, issuance of note payable in exchange for land, finance lease obligation used to acquire equipment. So where there is no cash inflow or outflow happening, it's a non-cash item, but you have to disclose it. So this is a nice summary, right, of operating, investing, financing activities. So let me quickly highlight the investing and financing, because everything else is operating anyways. So if you see here, paying interest is operating. I'm just highlighting this, and collecting interest on investment is also operating. Collecting dividends on investment is also operating, right? Only paying dividends is financing activity. Is that clear? Interest received, dividend received, interest paid are all operating. Only dividend paid is financing. And then the rest is something we have already discussed. Okay, so we can start with integrated reporting tomorrow. Let's take a pause here. Okay, so I'll see you tomorrow. Thank you and have a great day. See you tomorrow.